Hey guys, it's Sasha. The global energy crisis has just got a lot worse, and this winter will be brutal.
Hours after G7 leaders agreed to implement a price cap on Russian oil, intriguing time, and Gazprom reversed plans to resume gas flows through the Nord Stream pipeline.
2 days ago, Russia shut down the Nord Stream 1 gas pipeline to Germany, which is the biggest source of natural gas in Europe. Last year, Russia supplied 155 billion cubic meters of gas to Europe, which is about 40% of the total European gas usage. Nord Stream carried 59 billion cubic meters of gas out of the 155 billion total, so these two pipes under the Baltic Sea used to supply 15% of Europe's total gas demand. But Nord Stream isn't the only pipeline that feeds Russian gas to Europe. The Sakhanovka pipeline, which is part of the Soyuz line, had a capacity of 28 billion cubic meters, 19 of which made their way to Europe. And that pipeline runs through the Donetsk region, so Ukraine shut it down as soon as Russia started the invasion. The South Stream pipeline across the Black Sea has been shut down because countries like Bulgaria refused to pay for Russian gas in rubles. And the big Yamal pipeline that runs through Belarus was stopped earlier this year because Poland was also cut off by Russia for refusing to pay for Russian gas in rubles. And Poland has actually been pumping gas in the opposite direction along the pipeline from Germany. The Druzhba pipeline, where Druzhba means friendship or brotherhood, that runs through Russia and Ukraine, is the longest gas pipeline in the world. And that pipeline was shut down 4 weeks ago after Slovakia, Czech Republic and Hungary cited European sanctions and refused to pay Russia in rubles. And the only other pipeline that exists, Nord Stream 2, was going through final certification and approval as the Russian invasion began, and Germany immediately denied those permissions, which bankrupted the owner company, which was a subsidiary of Russia's energy giant Gazprom. So that project is over. In summary, Russian gas flow to Europe has now stopped, and the result is a massive panic for European consumers.
Potentially, we're going to spend most of the winter just in the one room with an electric fire, because that's probably going to be cheaper than firing up the central heating system constantly.
Energy prices have skyrocketed in recent months, with oil and gas prices exploding after European countries started imposing sanctions on Russia.
And it is energy that will drive skyrocketing inflation. Intervention could prevent the most dire predictions, but it will be complex.
Inflation in Europe has skyrocketed, fueled by high energy prices.
If you think inflation is bad here in the United States, Europe experiencing even worse inflation when you take a look, as you mentioned, at that 9.1% figure that they released in their flash estimate earlier this morning.
At the end of August, Russia shut down the Nord Stream pipeline for 3 days of maintenance because the system was apparently developing oil leaks. Russia is claiming that it is unable to repair these leaks because they can't get the equipment and parts they need because of, well, the sanctions. And the timing here is very convenient, as the technical maintenance was suddenly called just before the G7 met to discuss a cap on Russian oil prices.
Group of 7 finance ministers agreed on Friday to impose a price cap on Russian oil. They aim to slash revenues for Moscow's war in Ukraine, while keeping crude flowing to avoid price spikes.
The leaders of the 7 biggest economies in the world met and agreed to implement a price cap on Russian oil. The idea is that all of those countries will only pay up to a fixed maximum amount for Russian oil and will use their influence and power to encourage other countries to do the same. Naturally enough, Russia wasn't best pleased and immediately turned off the Nord Stream tap, cutting Europe off from Russian gas altogether. It's still not clear exactly how the price cap will work in practice in a complex global energy market. The G7 haven't even figured out what the price cap will be. This is all up for future discussions. The rumors are indicating something around the $50 to $60 range, which would be a third less than the current $90 oil price. And the G7 includes Canada and the United States, which don't rely on Russian oil and gas at all. And it also includes France, Germany, Italy, the UK, and the rest of the European Union, which have already been cut off from Russian gas and are imposing increasing sanctions on Russian oil themselves. So although the declaration shows intent, while it doesn't include China, India, Turkey, South Korea, Indonesia, and many other countries that are still buying Russian oil and buying more Russian oil, we will have to see what the exact impact is. The result of this energy crisis is a spiral in energy costs. Europe has been working hard to try and replace Russian gas, with Norway and the Netherlands stepping up production and filling Europe's gas storage. European energy ministers are putting on a brave face, saying that they are pumping huge amounts of gas into that storage apparently getting to 80% well ahead of the November deadline. Data from the International Energy Agency, though, shows that the gas storage accounts for a relatively small part of the total gas demand across Europe. And even in Germany, which has over a quarter of Europe's total gas storage, that storage does not have enough gas to last even 3 months. Analysis by data intelligence company called ICIS, shared with Reuters, showed that if Russia stopped pumping gas from October, and at the same time Europe managed to cut gas demand by 15%, which will be incredibly difficult, that would leave storage at 26% full at the end of the winter season. Now, Russia has cut off the gas supply at the beginning of September, a full month earlier than expected, and now there is a very real prospect that Europe will run out of gas this winter, especially if it's colder than average, even if they do find ways of drastically reducing usage. And finding ways of reducing usage by 15% is not going to be easy. It will mean enforced closure of commercial use and factories, and will have a massive impact on the economy. And on the back of this news, the euro has dipped to be worth just 99 US cents this morning, the lowest rate in 20 years. On the back of this panic, people in Europe are seeing their energy prices increase by a factor of 3 or 4. This is ridiculous. The official reason is, of course, placing the blame squarely at the foot of the price of oil and gas and the Russian invasion of Ukraine. But is that all there is to it? Because the situation, unfortunately, is far more complex than that. Europe has been making a lot of noise about going green, and some countries have been making moves in the right direction, for example, like the UK with wind farms. But in the background, Germany and Italy's dependence on Russian fossil fuels has got so bad that Germany has been shutting down its nuclear power plants while building a new gas pipeline from Russia. While Germany is announcing that everything is fine, they are also reopening previously closed coal-powered power plants in a panic move to try and stop blackouts this winter. And the attention is very much on energy prices, because oil is at $90, which is more than double what it has been for the last 5 years, and natural gas prices have spiked, trading at 3 times recent prices. But zoom out just a little, and you will start asking some important questions. Is the increase in price because of the increase in the prices of commodities, or is this trying to stem demand? Because gas prices between 2004 and 2008 were also very high. In fact, there were sustained periods during that time when gas prices were considerably higher than they are today for long periods of time. And oil prices spiked in the run-up to the financial crash and were roughly the same as they are today between 2010 and 2014, frequently breaking the $100 mark. And yet the UK has just increased the maximum cap on household energy bills by 200%, from £1,200 last winter to over £3,500 this winter, and they are expecting that cap to continue increasing by another 100% to almost £7,000 in spring. This price cap reflects the typical usage of an average household, and this increase will mean that very many people will have to choose between food and heating. Very literally. But if we look back to 2006, when the energy prices on energy commodities were somewhat similar, the annual energy bill for a typical UK household was less than £1,000. So what gives? Well, sure, we have 16 years of inflation and energy companies employ people and have costs, and those costs have gone up. Okay, I get it. But why the actual hell is the price of energy in Italy, UK, and many other European countries now 4 times as much? And why is it expected to go up to 8 times as much? Because of the commodity prices that are about the same as they were back then. Because commodity prices clearly are not the reason. Part of the reason, unfortunately, is gross corporate greed. You know the old saying about every crisis being someone's opportunity? Well, this crisis has certainly been an opportunity for energy companies. Saudi Aramco just posted absolutely shattering, record-setting quarterly profits, the biggest ever seen by a company in the world. But then you start looking a bit closer to home. BP just posted the biggest quarterly profit in 14 years with $10.9 billion in operating cash flow, despite still paying $1.2 billion a quarter for the Gulf of Mexico oil spill. The profits for BP were so good, they bought back $2.5 billion worth of stock and increased their dividend by 10% and announced they will buy back another $3.5 billion in stock next quarter. The level of profiteering in the energy sector has gone off the charts because of greed. And unfortunately, the politicians are in cahoots with the energy companies. So instead of, passing legislation to stop the energy companies from abusing their monopolies, Liz Truss, the brand new UK Prime Minister as of a few minutes ago, is proposing to dish out hundreds of millions of pounds to consumers so that they can then take those pounds, add some more of their own pounds, and pay them over to the energy companies. Makes perfect sense. Centrica has seen profits increase 400% at a time when energy costs are apparently the reason that your bills are going up. Great news for their shareholders. The boss of Shell has said that he is very sad about the fact that European gas shortages are likely to last several winters. So sad. We will have to have energy rationing, and I guess people will just have to pay more. By the way, Shell also posted their record profits in Q2, hitting $10 billion in the 3 months to June. There is a growing level of discontent about the situation with an exploding movement called Don't Pay UK, where 157,000 people, as I'm recording this video, have already committed to stop paying their energy bills from October, and you can kind of see their point. Sure, the global energy situation is really bad, but if the energy companies were genuinely squeezed and had their backs to the walls, it was an impossible situation. How do they survive? You would presume that the results last quarter, when energy prices were particularly high, when they spiked, would maybe be low, right? Maybe be roughly average, maybe be slightly below average. They are facing all of this pressure from governments, from their consumers, so they had to tighten their margins, they had to maybe take some losses, absorb some of the price increases. Well, the numbers are telling you the exact opposite. People are now getting into record levels of credit card debt just trying to make ends meet because of the inflation and trying to figure out how to pay for the heating. And the energy company bosses have decided to use this opportunity to make a quick buck on the back of people's misery. And one of the directors of Ofgem, the energy regulator in the UK that has just issued energy companies a free license to print money, has quit. Christine Farnish said she disagreed with the other members on the way the price cap is being calculated. The rest of the board of directors, who absolutely, definitely, in no way whatsoever are getting disgustingly bribed by the companies that they regulate, said that there is a very real risk of suppliers going bust. And yeah, there was a spate of energy companies going bust earlier this year in the UK, but these were middlemen companies that bought energy from suppliers, resold it to consumers, added absolutely nothing in the middle other than taking their cut, and they went bust because the big boys decided to keep the profits for themselves, as the numbers are showing. The big energy companies are all posting record-breaking profits instead. I guess letting energy companies charge 3 times as much a few days after they posted their record ever quarterly profit will definitely stop them from going bust.